Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, January 10th, 2025. We're only 10 days into the new year and already we have a problem. Today's jobs report for December came in much stronger than expected, suggesting the economy is growing at a fast enough pace without the need for lower interest rates. So you can see right up here in the report, very first line, 256,000 new jobs added to the economy versus an estimate of 165,000. So that's a huge miss to the upside. The unemployment rate held steady in December around 4.1%, while average hourly earnings rose by 0.3% last month and grew 3.9% during the past year. Now that may sound like good news to you and me, but Wall Street didn't like it. 30 minutes after this morning's opening bell, the S&P 500 index was down 1.6%, while the NASDAQ composite was off by 2%. So here's a chart of the past 6 months of the S&P 500, and you can see some peaking here in late November, early December, big drop, another recovery, big drop, littler recovery, and then this big drop here just within the past. So if I zoom into like the past month, you get a clearer idea of the pattern. But don't be misled by today's reaction to the jobs report. The problem is not what those numbers pretend for the economy. A strong jobs market is good for the economy because consumers have more money to spend, and our economy is primarily driven by consumer spending. The problem is that higher interest rates decrease the present value of future earnings. The mega cap tech stocks that exert undue influence on the major stock market indexes are largely priced on expected future earnings, so they're dragging down the stock market. So consider the behavior of the most valuable publicly traded company and indexes since the general election 9 weeks ago. So I'm going to pull up the chart for Apple here. Now this is the past 6 months. Now you see this huge spike here. That was December 26th, basically day after Christmas. And that was at above $260. And here today, this morning, when I first looked at it, it was down to below 240. Now it's at 236. So, you know, that's a big drop. And if Apple's dropping that much, then it's like a very heavy weight sort of pulling on the index. So let's look at the second most valuable publicly traded company. And it kind of depends on which day you look at it with as much volatility as these stocks have. But let's go with NVIDIA here. Now look at this 6-month chart wave on the right, this huge spike that peaks only a few days ago. It's down, well, let's see, it was, well, up here, you take a look, right around 150, now 135. That's a 10% drop. And I think this morning when I did the calculation, it was closer to 12%, and that was just 4 days ago. Even Tesla, which has a direct pipeline to the President of the United States, or the incoming President of the United States, pardon me, in the person of Elon Musk, has lost nearly a quarter of its value since surging to an all-time high last month. So here's the past 6 months. You see this spike here in December 17th. So here, let's go into 1 month. See, there's that big peak right there, right? Over 480, 486. Dropped down to 390 or so today. So as troubling as that appears, I don't believe it's anything to worry about. We have not yet seen the Q4 and full year results for those companies, much less the rest of the S&P 500 index. Nor do we know exactly what the fiscal policies the Trump administration is going to implement in the months and years to come. Wall Street is rightfully concerned about the potential adverse ramifications of a hot jobs market, but is overlooking the immediate beneficiary of strong employment, which is consumer spending. If retailers and home builders end up being adversely impacted by higher interest rates, then the financial markets will adjust accordingly. But right now, there is no empirical evidence to suggest that is the case. That's this week's update. I look forward to talking to you in another week. Thank you.